In our last meeting, we spoke at length about IFRS 3 acquisition of what? Of company, right? And we spoke about the steps, right? Business combination. The last time we talked about IFRS 3 business combination,
Yes, sir.
how business is acquired. So I gave you all the format that you needed to know. So today we are coming to talk about IFRS 10, consolidation of what? Of accounts or financial statement.
Okay.
So the consolidation of financial statements is all about what? When a company owns more than one company, the parent has to consolidate the account of what of the subsidiary, right?
Yes, sir.
So that is IFRS 10. So now have you seen the difference between IFRS 10 and then IFRS 3?
Yes. The
Uh,
three is yes, I've seen the difference.
yeah, the difference between the two. All right, so you need to be very careful.
Yeah.
They can ask you question regarding that. Okay, so let's continue. So now we are coming to, talk about the format of our consolidation financial statement, both the consolidated profit and loss account and then what? Zero financial position. All right, so you have what? Consolidated profit and loss and comprehensive and other comprehensive income. Okay, so this is how it looks. First, you have what? The group revenue, right? So the group revenue, you have your what? You have parent revenue plus subsidiary revenue.
Yeah.
Then you
Yes, sir.
less any intra-group, transaction. What this one means is that the intra-group transaction, whilst at it, you will be seeing some of the intra-group transaction and we'll deal with it, right?
Yes, sir.
Uh-huh. So the intra-group transaction, let me give you an example. If you have parents transacting with subsidiary, maybe the transaction worth 80 million, right? So here, parents sold to subsidiary. You understand? So you realize that when they're coming to do their group accounts, you see this 80 million will form part of what? Of their revenue. Have you seen it? So
Yes,
here,
sir.
the parent is a what? Is a seller, and then the subsidiary is a what? Is the buyer,
The
right?
buyer.
Now you realize that this 80 million, when you do the group, you realize that we have parent revenue plus what? Subsidiary revenue. You realize that this 80 million will form part of what? Of the revenue here.
Stop.
Now the
Yeah.
standards, the principle, this transaction must be removed because you cannot sell to yourself and make profit, right? So for that reason, we should remove this intra-group
Okay.
transaction. This 80 million was from the book because the parent has bought it. So in the book of parent, you realize that the parent will record as sales or revenue in their books. So that is why we said that in the intra-group transaction,
Yes,
we
sir.
should remove that transaction word from the book. Okay. Now let's move to the second one. The second one is what? Cost of sales. Now, under the cost of sale, you have what? Pay rent and what? Subsidiary. Now, when we say cost of sale, do you understand cost of sale?
Cost of sales, to my understanding, it is the cost incurred in order to
No,
be
cost of
able
sale
to
comprise.
produce
Listen, cost
or
of sale. No, no, no. Listen very carefully. Cost of sale comprise of you have your what? Your your beginning year, your opening stock, right? You have your what? Your opening stock. The stock that you carry from what from the previous years, right? Now this year you made purchases
yes,
of
sir.
what? Of goods or raw materials. You understand? You have purchases,
Yeah.
right? maybe you did what you
Yes, sir.
call you maybe you did what you call um um carried inward, or maybe you did what you call carried outwards of goods. Maybe there is supply that you have to what you have to send back. You are right. You less all these things. Do you understand? So you
Yes,
have
sir.
it like this. Now you come and what? Less your what? Closing what? So you come and less your closing inventory. So whatever you get is your what?
Cost of sale for the year.
Cost of sale, right?
Yes.
So what is the difference between cost of sale and goods available for sale? What's the difference
Cost of
between
sale.
cost of
Goods
sales and
available
goods
for sales.
available for sales? Cost of sales. So you've done the
Thank you.
cost of sales, right? Now, when we talk about goods
Goods
available for sale,
available for sale. Yeah,
so when
that
we
is
say
where you
goods available, so what do you mean? This one is what? Cost of sales. So now when we come to goods available, so you have your opening stock.
thank you.
You have your opening stock, and then yeah, you made some purchases of what? Of goods,
Okay.
right? You made some purchases of goods, right? Then you add them. So when you add them, what do you have? You understand? Do you
Okay.
understand? So this is what we call goods
Available
available for what? For
for
sale.
sale.
So this is what we call goods available for sale. Now, when you less closing stock, then it becomes cost of sales. Do you understand? Okay.
Okay.
So that's the difference. So you take note of that. Cost of sales. So when you have your cost of sale, you add your subsidiary, then you add your what? You add your parent to it, right? Now, when
Yes,
you
sir.
come, just like we did up there, take note of the reason why. I just want to show you the reason why all those deductions are there. I don't teach just like that. I teach to give explanation so that you're
The
not
principle.
yeah,
Okay.
you're not wonder why. So here you come and less again intra-group transaction. Can you explain why? Can you explain why?
But the intra-group transactions will be there because the entities are trading among themselves.
Uh-huh.
So the cost embedded by the subsidiary in, let's say, producing an item, that the cost incurred by the parent in producing an
No,
item
simply
to be
put
sold
this way,
to.
you have parent. Yeah, let's fast. You have parent transaction with what? With subsidiary. So the transaction is maybe 80 million, as I said. One is what?
Yes.
Selling, and one is what? Purchasing.
Buying.
You understand? So here, when you come to the revenue, the one who sold will have 80 million embedded in revenue. And the one who purchased will have what? 80 million embedded in the cost of sales. So you have to remove both. You have to remove the 80 million from it both. Because there shouldn't be any transaction like that. Assuming the parents sold it. So if parents sold it, he will be making revenue here, 80 million. Now, subsidiary bought it. So you will see it here. Subsidiary 80 million here and the cost of sales. So you
Yes.
will see that it reflects in both sides. So you have to remove it. Any question with that?
No, sir.
Okay. Now, so the next one is what we call the next one is what you add what you call unrealized profit. You add what you call unrealized profit. You add on. Why do we add unrealized profit? I told you that if there's maybe a subsidiary sold goods to parents, 80 million, right? Now, at the end of the accounting
Yes.
year, at the end of the account, so because the subsidiary is making profit, right? So at the end of the accounting year, if this transaction, you see this 80 million, they will remove it here and remove it here. Now, when they are removed, watch here. At the end of the accounting year, there is leftover over goods that the parent did not sell. So assuming 80 million out of 80 million, that's what 10 million unsold goods. Now, this 10 million unsold goods, it has what profit margin in it.
Okay.
You understand? So we will have to come and do calculation and remove this profit margin if maybe they're giving you markup of 20%. So you can 10 multiply by what? 20% over 120, right?
Yes,
Then
sir.
when you calculate, whatever you get is termed as what? Unrealized profit. So this unrealized profit will come and add it here. When we add it here, remember the one who sold the goods has already recorded that profit in the revenue. You understand? We are
Okay.
assuming the parent subsidiary sold the goods. Remember, he has already made profit of what? Profit on this 10 million already. And they added it here. So we'll come and remove that
From the
unsold.
cost of sale.
Do you understand? So no, we will come and remove it here. From the cost of sale, because it is the profit is part of revenue. So you have to come and
Exactly.
less it here. Do you understand? Then we remove it. Are you with me? Because
Okay.
remember,
Yep.
because this 10 million is part of 18 million, that's already been removed. Do you understand? Now the
Yes, sir.
unsold goods, the profit margin in it, you have to come and less it here as well, right? Okay. So
Okay.
that is why that calculation is like that. Depreciation. You understand? So can you see everything is depreciation? Can you see it?
Yes, sir.
Good. So this depreciation stands for, so we come and learn depreciation from here. Watch here. You have you have an asset, maybe PPE, right? Before acquisition of PPE, the value of the PPE was 40 million. Now, after the asset was acquired and being reported, now the PPE now values at what? 50 million. So there's what we call fair value of this asset. Do you understand? So you have what?
Sure.
Fair value or revaluation gain of what? 10 million.
Yeah.
Do you understand? And remember, this revaluation of 10 million, we calculate depreciation in when we were calculating net assets of subsidiary. Remember?
Yes, sir.
Net asset of subsidiary. That's where you find this transaction there, right? You have at acquisition, at what? At reporting.
Reporting.
You understand?
Who's
So the PP fair value is what comes here, right? Aha. So you have that PPA. And I told you that this PPE has increased in value. So this fair value of that PPE 10 million depreciation has not affected it yet, right? So this depreciation has not affected. So how do we calculate it here? When you come to a net asset of subsidiary, how do we calculate it? I said that at acquisition, we don't calculate depreciation at the beginning of what? Of the account year, but at reporting, when we are coming to report, then we calculate depreciation on it. Remember that you bring the 10 million here, right? Then you bring 10 million here. Then you come and calculate depreciation on it. Do you understand? So how do you calculate it? If it is what useful life is what 10 years, you have what 10 over what? Over 10. You understand? Here, then you come and less what 1 from it. Right here. So at the end, you have what -1 also here.
1?
Do you understand? So this
Yes, sir.
depreciation, right? This depreciation is what I'm talking about. It will come here. You'll come and add it here. And less is from what? From the revenue. Because you know how depreciation works. Depreciation affects what? Administrative cost, or is part of what? General expenses of what? Or operating cost. Right? When you will less it before you can get your net profit. Right? Now, in the acquisition, that is how depreciation, that was what? That's how depreciation is calculated for an acquired what subsidiary later when reporting is being what is being compiled. So the next item is what when you less it. So here you have it here. Then you come and less these things from it. So whatever you get becomes your what? Your gross profit. Okay, so this becomes your what? Your gross profit, right? Okay. So from
Sure.
here you have your what? Your administrative expenses. Now, under administrative, you have a whole lot of expenses that you may. So you have maybe your distribution cost, example of some of the costs that you may see. So you have your administrative distribution cost. You have maybe selling and selling and admin. That one too is like parent plus what plus subsidiary. Then you put it there. The same thing here, parent plus subsidiary. That one too, you put it there. Okay. Now, the selling and administrating could be what? Marketing, you understand, or the product. You also have what? goodwill impairment. Now, goodwill impairment, you also have what? Parent plus what? Plus subsidiary. All right. So you may also have what we call finance cost. So if you don't find finance cost, or you find what unwound, they're all talking about the same thing, right?
Okay.
Parent plus what? Plus subsidiary. You have this. Okay. And then you may have also share of what? Association. You know association?
Yeah, association. That is
Okay, all right. So you have,
from 20 to
yeah, you have, so here to this one is a percentage from what? Share of association. So it's a percentage of what? Of the parent having in what association. So that comes here. Are you with me? Okay.
yes, sir.
So because if a parent, you have parent company, you have associate. So when associate makes profits, this probably maybe 10 million. So this 10 million is shared between association and what? And parent. So maybe if parent has maybe 20% in the associate company, you have to calculate 20% on the profit, then you bring it here.
10 million.
All right. So that is it about that. And then you also have maybe, if maybe you have maybe other expenses. Okay, then you will bring that one to here. You have maybe parent, and then what? Parent plus what? Subsidiary. Okay. Then before you come and what? Calculate your whatsoever. So here, remember, you should be able to identify them all. This one is expenses. This one is expenses. This one is expenses. This one is expenses. So associate is what? It's a what? It's a gain. So this one is expense. So when you add all of them, what do you have? You understand? So when you add all of them, whatever you get is what? Maybe whatever you get, you will bring it here. You will bring it here. Then you will less. So whatever you get is what? Profit before what? Your profit before tax. Now you have your what? Your profit before tax. All right. So your profit before tax is that. So when you come, you come and what? You come and charge tax on it. So you have what? Your parent plus what? Plus subsidiary. How much is tax? You will bring it here. Now when you are done, what do you have? Then you will bring your what? You will bring your what? Your profit after tax. Okay, so that is it about that. Now, when you are done, then you come and do what we call other comprehensive income. Other comprehensive income. So other comprehensive income, maybe you have what? Your revaluation surplus or reserve. Maybe there's a company that has valued its assets. So that is it. Then you can bring your revaluation surplus here, and you add it. So whatever you get is what is your profit. So yeah, profit after tax is that. Then revaluation, you have what your profit after, or your other net profit, or comprehensive net profit. That is it about this one. Are you with me? All right, so we are done with what? We have done
Yes,
with what? Profit and loss and other
sir.
comprehensive
Go to the
income.
right side. The right side. Let me see where the segments are. The sign. So the final answer is the net profit.
Yeah, let me say, though the profit after tax is the true profit, true operating profit of the company. Do you understand?
Okay.
Now, net profit after other comprehensive income item, right? Let me put it in the bracket. After OCI also speaks something. Take note of that. So here, let me give you example. Let me give you this is under IAS 16, right? Now, under IAS 16, there, what can affect under IAS 16 where a company adopt what we call revaluation model for revaluation model for what we call remeasurement or subsequent measurement of what of it asset or PPE, right? So when they adapt that one, what possibly could affect the value of what of PPE or asset? One, IAS what 21, and then what IAS what 29. Do you understand? And maybe the nature of what of the assets. All these can affect the value of what?
Sir, please, I'm coming. Sir, you said what? Revaluation what?
Revaluation model
The top one.
for subsequent
For
measurement of assets. Now, so if you have an asset, what can cause asset to value above or below book value? Above or below book value? Below book value are one, IAS 21 or IAS 29 or nature of the asset can all cause asset to, or maybe even economic factors can cause asset to what? To value, an economic factor can even fall under IAS 29. All these things can what? Or maybe technology can all affect how asset can what? Can value low or high as they sit in your what? In your book. So if you have asset PPE, under IAS 16, maybe you have PPE or asset in your book, maybe it is 50 million. Now, when you acquire this asset 50 million, exchange rate was maybe 15 Ghana cedis per what? Per $1. You understand? That's how much you bought the asset. Do you understand? And you bought it in what? You bought it in dollars and you converted it into Ghana cedis, right? So when you were buying this asset, this is the exchange rate. Assuming you bought it in what? In dollars, as at the time, right? So if you bought it in dollars and you want to convert it in Ghana cedis, how will you convert the asset in Ghana cedis? Are you with me? So
you bought it 50 million what? 50 million Ghana cedi or
so assuming maybe you bought the PPE for $5 million. Let's assume
yes.
$5 million, right? At the exchange rate of maybe 15 to $1. Now,
Okay.
you are Ghana. Your reporting currency or your functional currency is what?
CD.
Good. It's CD. So how do you report this in your book when you acquire this asset at this rate? So all you have to come and do here, you have your 5 million Ghana cedis multiply by how much? The 15 Ghana cedis. Convert it. How much is 75 million Ghana cedis, right?
Yes.
So
Sir.
here,
yes,
this
sir.
one will sit in your book as what? As the value of what? Of your asset, right? Now, at the end of the accounting year, the exchange rate now is 10 cedi for what? For $1. Have you seen it? So if 10 cedi for $1, now you are coming to do the how much did you buy the asset earlier? You bought the asset 5 million. Now the exchange rate is what? 10 million. How much is the value of what? Of your asset in your book? That would be what? 50 million. So you realize that there's what you call revaluation. So here you will see that when I'm coming to do your revaluation on this asset, this is how much your asset now values in your books, right? So here, how do you calculate your PPE or the asset? You have your in your original book value or carrying amount of the asset from the beginning of accounting year was 75 million. Now your PPE now values. So that's why you have your revaluation valued at 50. So there's a revaluation loss of what? Of 15 million. Can't you
50
see
million.
that?
Yes, sir.
So this 15 million, how do you report it in your books? All you have to do is that you will come to what? Your other comprehensive income, OCR.
Okay.
Then you come and report it as revaluation what? Revaluation. Listen very carefully here.
Thank you, sir.
This is revaluation loss. Assuming this is the first time measurement of this asset and they lost. If they lost, this money will go to profit and loss account. It will not come to other comprehensive income. No.
If that is the first time.
If that's the first time.
Thank you. Thank
you. Understand? So if that's the first time of what? Of the asset losing value, it will go to profit and loss account straight. You will not take it to other company here. Assuming this is the first time, it will not come here. You will take it to profit and loss account straight. Assuming they already have existing revaluation surplus sitting in their books, then you will bring this maybe 15 million. Assuming they have maybe 15 million here, you will bring the 15 million and come and less it from this one. You understand? So there, whatever is left is what is the revaluation balance that you have. Then when you are done, then you take it to what? You take it to balance sheet under what? Under equity. Then you also go and do what? You will bring revaluation loss there. Revaluation surplus. Then you bring the what? The revaluation loss, which is 50 million minus what? The 50 million loss that you have. Whatever you get is the balance. So this is how the IFRS system is reported in our books. So you take note of these comprehensive income matters. The other comprehensive income is not only PPE items that go there. You can also have IFRS 9 item also go in there, which is investment. You understand?
Okay.
IFRS 9 item, which is also going there. And the IFRS 9, we have categories of reporting. It depends on which category. If the category say you should want to report through OCI, then it will go to OCI.
Thank you, sir.
And a real situation where you have OCI item, example, you have OCI item, maybe revaluation surplus sitting in your book, and it was what? It was maybe 50 sitting in your book. And subsequently, you calculated the revaluation again. Maybe you have assets, the PPE assets. Maybe you have PPE, and the PPE was 100 million. And now the PPE, after you did the revaluation, now the PPE is what? 40 million. You rather there's a revaluation loss on this PPE, which is how much? 60 million. Right? So when you come here, when you bring it to the OCI, you already have existing revaluation gain here, 60 million. But the loss that you have here is more than the gain here. Do you understand? So when you come and let the 60 million, you realize that you still have what? Minus 10. So this minus 10 will go to profit and loss account. So these are some of the information that as a chartered accountant is what you should be having. Now we are done with profit and loss account. So let us go to statement of what? Financial consolidated statement of what? Financial what? Position. So here, now, I always say that when you look at accounting or corporate reporting, you have your non-current asset. So your non-current asset, you will have maybe your PPE. You will add what? You will add both parent and subsidiary. You put it there. You have maybe your intangible asset. You have your parent plus your subsidiary. You also have your parent. Maybe your investment could be from only parents. There's a reason why you are the only parents. Or you can only parent. Okay. You also have maybe your goodwill. Goodwill is work. So you can also have it as for only parents. Okay. You can have it as subsidiary. So this the reason why I'm bringing this one is because of complex group. Complex group, you have more than one goodwill. Okay, then you have also your what again?
Then we move to current asset.
You have what? Your current
assets.
Your current assets. So you will have your what? Your inventory. You will have your what? Your parent plus your subsidiary. Watch here. Then you less your unrealized profit.
Okay. The one we added to cost.
Yes. You come and less it here as well.
Thank you.
And remove it. You have your receivables. You have your parent plus your subsidiary. Then here you will also come and less your intra-group transaction. right? All these things you will come and you will see them. You also have cash and bank. You have what your parent plus your subsidiary. Then you add what we call in transit. In transit, maybe there's a money that are on its way but yet to be received. So if we can recognize them, then what add them here. If it can be identified. Okay, so these are what you should know. Okay, investment, or maybe you can have maybe investment in what in associate. Let me clarify that. Okay, so what again? And then you will have. Okay, so what again? So when you are done, you add them. I guess you are what your total asset. So you come and do your what your equity and what your liability. Okay, so under the equity and liability, what do you have? You will have your equity, which is what we don't consolidate equity, right? Only parents. You understand? Okay.
Yes, sir.
Now, oh, I should have done it here. Then I call it maybe share capital. This is only parents. Then we can have whatever. Maybe you have maybe you will have your revaluation surplus. You will have it. Maybe you have your retained and which is wet. You will bring it here. Goodwill is also wet. Then when you are done, then you will come and bring your what non-controlling interest here. Which will come here.
Sir,
Yeah,
please,
this
I
one
need
too
this
is wet.
clarity. What is the difference between revaluation reserve and revaluation surplus
The
or
same
loss?
thing, my brother.
Thank you very much.
The same. All right. So when you are done, then we come here. Then you come and do our what non-controlling interests. Sorry, non-current assets. Okay. So under the non-current asset, what do we have here? You have maybe example. You have your debentures. If both have so parent plus sub. Then we have your deferred consideration. You remember consideration?
Yes, sir. Yes,
Deferred
we did.
consideration. Deferred
We did.
consideration. They are consideration that will be paid in the near future.
Yeah, after
Right.
1 or
Yes.
2 years.
You have maybe your current liability. Okay. You have your payout. That too, you'll bring it here. Then you'll have your maybe your bank overdraft. Bank overdraft. Parent plus subsidiary. I want to bring it to plus subsidiary. I want to bring. You'll bring your what? Your unwound, unwind or unwound discounts. I want to you'll bring it to. You see, some people decide to what? Add the unwound discount to the fair consideration and make it a full figure, right? Okay, so if the fair consideration is 50 million and the interest is maybe 5 million, they can decide to add the two and put it here, or they can separate it and the 5 million will be the finance cost or unwound discount. Okay. So when you are done, whatever you get is your what? Is your total equity and liability. Okay. Total equity.